Good morning. We will pay attention to credit sales and returns when the customers are not satisfied with the item. When we use the perpetual inventory system, the value of inventory on hand can be determined at any stage during the financial year by balancing the inventory account. So every time that we purchase goods, whether it's cash or credit, we will debit the inventory account. Every time that we sell goods, we will credit the inventory account to indicate that the inventory decreased. If goods are returned by debtors, we will debit the inventory account to indicate that the inventory increased. And if we return to creditors, we will credit the inventory account to show that it decreased. That means at the end of any month, you can work out what is the balance in your inventory account, and that balance that you have in the inventory account is the indication of the value of inventory on hand or the total value of inventory in your business. When we sell goods or the goods are returned, we complete two double entries. One for the credit sales price and the other one for the cost price. So if we sell goods on credit, we will debit the debtors control to indicate that the asset increased because they owe us more money. We will credit the sales account to indicate that the income of the business increased because income increases on the credit side. This entry will be completed at the sales price. The second double entry will be completed at the cost price, where I will debit cost of sales to indicate the expense to be able to sell the goods. So the cost of sales is the expense account that increases on the debit side, and we will credit inventory to indicate that the asset decrease because we don't have the goods in the business anymore. When goods are returned, we will also complete two double entries. The first double entry will be at the sales price again. We want to reduce this sales because we don't have that income anymore. They return the goods, and sales is reduced via the debtors allowances account. So I will debit my debtors allowances account to decrease my income. I will credit the debtors control account to decrease the asset because the debtors owe us less money. The second double entry will be completed at cost price. The goods are returned, so it's put back into the inventory. So I will debit the inventory account to increase the asset. And we want to reduce this cost of sales that we created, the expense when we sold the goods. We want to reduce the cost of sales now because the goods are not sold, so it can't form part of the expense for cost of sales. Any entry to increase or decrease in inventory will always be entered in the inventory account. So any increase or decrease will be entered in the inventory account. When goods are sold for cash or on credit or returned by a debtor, it will always have an effect on cost of sales and inventory. Mamelodi traders maintain a profit of 25% on cost price. If the profit is on cost price, the cost price is 100%, the profit is 25%, and the sales price is 125%. We must determine whether the cost price or the sales price of the goods are given. They say the cost price of the goods is 2,500. So the amount provided is cost price. So next to cost price, we will show that 100% equals 2,500. If we want to calculate the sales price, we will multiply with the one that we want to calculate divide by the percentage that we know times the amount, and that will give us the sales price as 3,125. The debtors is an asset. Asset increases on the debit side and decrease on the credit side. The debtors will increase with the sales price because they owe us the sales price of the goods, and we will indicate that the sales account will be credited to complete the double entry. Sales is credited to indicate that the income increased on the credit side, and we will write the word debtors control to indicate that this double entry is in the debtors control account. Then we will debit the cost of sales account, that is an expense. Expenses increase on the debit side, so we indicate that the expense for cost of sales increased with the 2,500 cost price of the goods that was sold, and the inventory account will be credited. Inventory is credited because inventory is an asset. Assets increase on the debit side and decrease on the credit side. Inventory was sold, so we have less inventory, so we will credit the inventory with a cost price of 2,500. Issued a credit note for 600 for goods returned. So when we sell goods, we issue an invoice. When we want to reduce the account of a debtor, we issue a credit note to indicate that we will credit the account to reduce the debt. The credit note will indicate the sales price of the goods because we tell the debtors that we will reduce their account with a sales price of 600 Rand. The cost price is 100%, the profit is 25, the sales price is 125, the sales price is given as 600. So if we want to calculate the cost price, the one that we want divided by the percentage that we know, 125, times the 600, and that will give us the cost price of 480. So when the goods were sold, we recorded an entry at the 2,500 sales price, and we recorded an entry at the cost price of 3,125. When the goods are returned, we also have to complete a double entry for the sales price and the cost price. The debtors owe less money, so we will credit their account with 600 Rand to reduce their debt, and we will debit debtors' allowances with 600 Rand to show that the debtors' profit is reduced because we actually decrease our sales income when the goods are returned. So sales are decreased via the debtors' allowances account to indicate that the profit will now decrease as a result of the goods coming back. We will debit the inventory account to indicate that the inventory increased because we received the goods back, and we will credit cost of sales with the 480 to indicate that the double entry was in the inventory account. Cost of sales is credited to reduce the expense because these goods are not sold anymore. What did we learn? 2 double entries must be completed when goods are sold or when goods are returned. 1 double entry will be recorded at sales price and 1 double entry will be recorded at cost price. Assets and expenses increase on the debit side. Liabilities and income increase on the credit side.